Have you ever wondered how exchanges decide exactly how much capital you need to put down for a leveraged trade, even before you enter it? Initial margin levels are primarily determined by a combination of factors related to market risk, the specific asset being traded, and the policies of the exchange or broker you are using. This required amount is essentially a good faith deposit, ensuring you have enough capital to cover potential losses from adverse price movements in your position. The fundamental why behind these calculations is risk management. Exchanges and brokers must protect themselves and the integrity of the market from excessive counterparty risk. When you open a leveraged position, you are effectively borrowing funds. The initial margin acts as a buffer against your borrowed capital, aiming to prevent your account from going into a negative balance should the trade move against you significantly. It is a critical safeguard in the world of crypto derivatives. Several key elements influence this calculation. First, asset volatility plays a huge role. Highly volatile cryptocurrencies, known for their rapid price swings, will typically demand a higher initial margin percentage because they carry a greater risk of large, sudden losses. Second, the leverage ratio you choose directly impacts your margin. A higher leverage ratio means you are borrowing more relative to your own capital, so the exchange will requiring a proportionally larger initial margin to cover that increased risk. Third, the overall market conditions, such as liquidity and systemic risk, can also lead exchanges to adjust their margin requirements. For instance, during periods of extreme market uncertainty, exchanges may temporarily increase initial margin rates across the board to mitigate heightened risk. Understanding these dynamics allows you to better manage your trading capital. Before opening a position, always check the exchange's specific margin requirements for the asset and leverage level you intend to use. Most platforms provide a margin calculator or display this information clearly in the trade interface. You might notice that different exchanges can have slightly varying initial margin percentages for the same asset due to their unique risk models and liquidity pools. This is why comparing margin rates across platforms can be a valuable part of your pre-trade preparation, especially when considering a significant leveraged position. Ultimately, the level of initial margin you are asked to provide is a direct reflection of the perceived risk associated with your leveraged trade. By grasping these underlying factors, you gain greater control over your capital allocation, enhance your risk management strategies, and can make more informed decisions when navigating the exciting but challenging landscape of crypto derivatives.